I'm going to continue our discussion about microsimulation modeling of tax policy. In particular, I'm going to show you a tool called TaxBrain that can be useful for doing revenue estimates and distributional analysis of federal income and payroll taxes. So I'm going to begin just by showing you some of the documentation, and then I'm going to share an example of the use case for TaxBrain. Okay, so right now I'm sharing uh, hide this. I'm sharing a website. It's taxbrain.pslmodels.org. Will take you to the documentation for the TaxBrain model. TaxBrain itself is really just a wrapper for a microsimulation model called Tax Calculator. Tax Calculator documentation can be found at taxcalc.pslmodels.org. And let me describe this underlying model briefly first, and then I'll talk about TaxBrain more specifically. So the underlying microsimulation model Tax Calculator is essentially a set or computer code that represents the logic of the Internal Revenue Code. So it's, think about like a TurboTax that you can just feed data into. And if those data have the right structure, you're going to get returned the resulting tax liability for individual records in those data. And then, of course, if you have a suitable data set to represent the nation, you can aggregate up and produce revenue estimates nationwide. Tax Calculator itself is an open source model. It can be used directly through a Python API or a command line interface. But what TaxBrain does is provides a wrapper to interact with Tax Calculator very simply. So TaxBrain is useful as a quick way to produce revenue estimates, produce distributional analysis with Tax Calculator. I'll go back and forth because the way we're going to interact with TaxBrain here is through the Python API. There is also a command line interface to interact with TaxBrain. There are web applications built on TaxBrain. I know a couple organizations represented here today are using or are in the process of building graphical user interface web applications on TaxBrain. There used to be one hosted freely to the public at Compute Studio. However, that was funded in the past by the Open Source Policy Center at AEI and the University of Chicago's Becker-Friedman Institute. That funding has kind of dried up, so there's not a free version of the graphical user interface available to everybody. But you can still run this freely with, you just have to interact with the Python code. And so I'm going to show you that today. Hopefully it's not too scary for those of you who don't have a background with Python. I'm going to take it step by step, show you how to produce a revenue estimate and kind of point out where you can modify things to change that to represent policies you're interested in, okay? So again, a lot of documentation at taxbrain.pslmodels.org. And what I'm going to do is I'm going to walk through a notebook here, what's called a Jupyter notebook. This that you're seeing is hosted on Google in their Colab platform. And I'm going to go to share this a link I'll put in the chat here. So everybody, if you wish, you can follow along at this link. There'll be one difference between that link and what I show you in a moment, and that is a data file that's used. But I'll show you that in just a second. So let me share my Visual Studio Code. And I'm going to walk through the usage of TaxBrain here. All right, and so I'm going to have a specific example. We're going to do kind of a traditional 10-year revenue estimate. And we're going to do that with an example that is like permanence of the Tax Cuts and Jobs Act. Okay, so I'm going to show you how that's represented in the format that's suitable for going into Tax Calculator, which is what TaxBrain is eventually going to call for the microsimulation modeling. Again, so we're going to walk through, you're going to see a little bit of code. I'm going to try to describe each component of it, but if you have questions, please raise your hand or put a comment in the chat. I'll do my best to monitor that as we go. Okay, so again, we're going to score tax policy with TaxBrain, a few notes at the top, and then we're just, this does require a few packages. I know on my local machine, if I'm in the right Environment, I've got those packages installed, so I'm just going to import what's needed. There's a block of code at the top that if you're working in Google Colab, you'll need some of these custom Python packages, TaxBrain, Tax Calculator, and a couple others that aren't installed as dependencies automatically. And those, that initial block I'm not going to execute here is something you will execute on the Google Colab to make sure you have everything you need. The nice thing about Google Colab, though, is you don't need to install Python on your machine. You can do this entirely in the cloud, and the link I sent you should fully execute in the cloud. All right. So with that, what do we need to produce a revenue estimate? Well, we need some change in policy, and we're going to also want to specify the years over which we're going to analyze that change in policy. So the very first block of code I have here is going to do two things. First, it's going to find a reform policy or some change in tax policy we're going to analyze the difference relative to. And then we're going to look at a certain set of years over which to analyze those differences. So we'll have our start year 2025, we'll go out 10 years, so our end year will be 2034. And this, what's called ref here, is going to be the reform that we're specifying, okay? And TaxBrain is going to, again, take the input that tax calculator is expecting here. So there's a certain format with which we need to specify these policy changes. By default, tax calculator and TaxBrain are going to have a baseline that is a current law baseline. There are options to change that baseline, but unless you specify something different, your baseline is going to be that current law baseline. So we're going to specify our reform, and we're going to look at changes between the baseline, in this case, a current law baseline, and that reform. All right. So you can see here as a reform, I've specified this URL. All right. So that URL, let me just copy that and share my Chrome window. I'll just go to that URL. And what does it look like here? Well, it looks like kind of like a text file. You can see there's an extension .json or JSON. This stands for JavaScript Object Notation. This is kind of a standard data format. The couple nice things about it: one, it's fairly easy for humans to read it. Number two, it's hierarchical, so we can nest things. If you're familiar with Python, the format of these JSON files is very much like a Python dictionary. There's a key and then a value associated with that key. All right, so we have some commented lines at the top, which are kind of telling you what this reform is. Extend the temporary provisions of the TCJA beyond 2025. It's used with the latest version of Tax Calculator. And then it also has some notes about the indexing factor used for inflation indexing here. Below that, you're going to see a set of keys like IIRT1 and then values associated with those keys, like 2026.1. What these are parameter names, are what are in those first quotes, those first keys here. So IITRT1 is the individual income tax rate in the first bracket. So that's kind of coming from Tax Calculator. That's the name of that parameter. And then following that is this key value pair. 2026 is the key. That's the year these things start. And then the value is set the rate in that first bracket to 10% starting in 2026. The assumption made here is that it's going to extend indefinitely unless you put another year in which that bracket would change, then a year after 2026. All right, so what this JSON file is specifying is, again, extension of the Tax Cuts and Jobs Act, the temporary provisions that expire in 2025. So you're going to see the years here are all 2026. We're going to start in 2026 to make sure those parameters don't revert to their pre-TCJA values. And so we'll do that for the first bracket rate, for the first bracket income thresholds, the pass-through rate in the first bracket, and for the second, third, and so on. And so you can see all those individual income rates are updated, as well as the bracket thresholds with extension. Changes also to the CTC, the Advanced Child Tax Credit, and other credits here as well, the AMT. All of these things here are parameters or law that's going to change at the end of 2025 unless there is an extension to the Tax Cuts and Jobs Act. That extension is exactly what this file is simulating by specifying how those parameters in the tax calculator model should change from 2026 going forward. Now, again, so there's a specific format that these parameters and their associated values are expected to be in. This particular file provides one example of that format. Again, for other details on this, you can go to the tax calculator documentation, user guide, and it's going to have a list of all of those policy parameters and what values they take by default. It'll have also examples for dealing with the Python or command line interface, and then what are called recipes or example files to do this. And so what I'm previewing with you today is essentially another one of these recipes where we're going to do an analysis of a tax reform, but this time through TaxBrain. Okay. All right, so let me switch back to my notebook that I'm going to run locally. And so we're going to read in that JSON file that we just detailed, okay, with those changes to maintain permanence of those temporary provisions of the TCJA. And we're going to analyze what effect that has on revenue and then distributional implications of it from 2025 to 2034. So again, a typical 10-year revenue estimate. So I'm just going to execute that cell, which is going to read that JSON file, put it in a Python dictionary, and then set these start and end year values. All right, once we've done that, now we move to actually interacting with TaxBrain. All right, so this example here is going to be the simplest interaction we can have with TaxBrain. So we're going to instantiate a TaxBrain object, which requires a couple of values. So we got to give it a start and end year. We are going to provide an argument for what microdata to use. And then we're going to provide what is that reform policy. Again, there are many other parameters or keyword arguments we could pass here, but this will satisfy for what we want to do here. We're going to say, let's do a simulation that starts in 2025, goes through 2034. The reform we're going to look at is permanence of those temporary provisions of the TCJA. And for data, we're going to use this freely available current population survey-based file. Okay. There are other files you can take in. I'm going to give an example in a minute of using what I think is the premier data file for revenue estimating outside of the confidential data at Treasury and JCT. But for now, I'm going to do this simulation with data that we can all use, the current population data. This is something that ships with Tax Calculator. So when we above installed Tax Calculator, that came with the CPS data we're going to use for this simulation. It's not probably the best file, but it is a file we can run, and everybody who has Tax Calculator has access to this file. Okay, I'll show you a better file in a minute, but most of you all will not have access to that. All right, so I'm going to execute this cell, which is going to do two things. First, it's going to create this object, this TaxBrain object we're going to call TB static. And that's going to, I named it that because what we're doing here is what is a truly static simulation. So we're going to look at all of our records in this CPS microdata. So think about each row of these data is representing a tax filer. And we're going to compute their tax liability under the baseline that is current law. And then we're going to do it again under this reform policy, which is permanence of TCJA. And we're going to do that for every year from 2025 to 2034. Okay. And so when I do tbstatic.run, it's going to execute that simulation. So the first line was just to set up this TaxBrain object. The next is, okay, go ahead and simulate the model for both the baseline and reform for 10 years on each of those. All right. Once we have that, we've got this tbstatic object that contains all of the microdata, all of those CPS-based records, and there, for each of those records, tax liability, after tax income, et cetera, for current law, and then for this reform that is permanence of TCJA. So we can then, with that, we could compute, for instance, what are the revenue implications of extending the individual income tax provisions of the Tax Cuts and Jobs Act. And I should say more precisely, the individual income tax provisions that are, that we're able to model here. There are maybe some off-model provisions, so changes to the estate tax, for instance, that aren't handled in tax calculator. Those won't be included here. But many, and in particular, most substantial provisions, we are able to capture here. So here we've just used this weighted totals method of this TaxBrain object to find the changes in combined tax liabilities. So that means income and payroll taxes for each year in our budget window, as well as the total over those 10 years. All of these numbers here, we put them in billions, so you can see kind of, no effect in 2025, but after expiration of those individual income tax provisions, if we were to extend them in 2026, the revenue cost on a, again, purely static basis, so people are earning the same income, they just now face different tax rates, that would cost about $215 billion in 2026 and about 2.1 trillion over the 10-year budget window. Okay. All right, so that's a simple revenue estimate. We, after importing what we needed, we really just had like 5 lines of code to set up our parameters, run TaxBrain, and then produce this 10-year budget estimate. Okay. So again, a little bit scary here. We don't have the nice graphical user interface at the moment freely available as Policy Engine does, but again, with minimal Python code, we can produce 10-year revenue estimates. So that's just the very basic thing we can do. I'm going to go through some other options, some really, I think, nice features of TaxBrain. And first of those is the ability to use alternative data sources. So really, as long as your data conform to what tax calculator is expecting, you can use it in TaxBrain. And what is tax calculator expecting? Well, there's a few minimum sets of variables you need to have. So everybody, you need to have marital status, you need to have a weight variable, you need to have total number of dependents, and I think that's really it. I might be missing 1 or 2, but there's the required number of variables is very minimal to run tax calculator and therefore to run TaxBrain. So if you have a data set with at least those 3 or 5 variables you'll need, you're able to run it through TaxBrain. Of course, more variables are going to help you find more detail. And then there's a naming convention with respect to those input variables. So tax calculator is expecting variable names that follow the IRS variable names. So the SOI names given to those variables in the public use file, that's what TaxBrain is expecting. So if you were to use the current population survey and they have, and I'm forgetting the variable name in the CPS, but there's a wages and salaries variable, you would need to change that name from, again, whatever it is, wages or something in the CPS to the variable name that corresponds to wages and salaries per the SOI variable naming conventions, which is E00200. So those names are a little bit cumbersome, but all of that is documented in the tax calculator documentation at taxcalc.pslmodels.org. So you can find exactly what each of those variable names means. So if you had a custom data set, you can map it in there. But there are several data sets that are set up to be run through tax calculator and therefore TaxBrain. When we've already run one of those, that is the CPS file that ships with TaxBrain. There is a project called Tax Data, which produces that CPS file. It also produces a public use-based file. So that IRS public use survey, that max detail, that is the basis for this or helps with this enhanced CPS policy engine uses. There is a data file produced by a project called Tax Data that uses a public use-based file based on the 2012 public use file. But a more recent project, and again, what I think is kind of the gold standard for doing these revenue estimates at this point, as far as public, somewhat publicly available data, is done by the Tax Microdata Benchmarking Project. They have produced a file based on the 2015 IRS public use file in combination with survey data to impute non-filers. They have many targets and they match those targets very well. So this file is quite accurate in producing, totals as well as distributional analysis that match real world IRS targets and other things we've observed in the data from, CBO forecasts and so on. And so this file is a great asset to the analysis of tax policy. I provide a link here to that project. And that file, though, the project is all open source, but to create the file, you do need that 2015 PUF, which is, as Max mentioned, somewhat available. And if you purchase that 2015 PUF, you're able to run the tax microdata benchmarking code with that pointing to where your 2015 PUF resides and produce the files I'm going to use here. Those files that come out of that project are a data file called tmd.csv, and then files for growth factors and TMD, and then for weights. And let me talk about which each of those are. So there are the underlying data, which is just a cross section. Again, in each row is a record, columns are those input variables. And then with that, to make sure this kind of represents what we expect to happen over this budget window, so what we expect in 2026, 2027, and so on through 2034 in this case, we're going to combine that cross-sectional data with a series of growth factors and a series of weights. And what those are going to do is they're going to reweight that data file to help match targets pulled from SOI and other places. And then the growth factors are going to extrapolate that out over the budget window. Okay, so these three things in combination are going to give us an accurate representation of what's happening over the budget window. Okay. And I saw Martin in the chat noted I might have the wrong file name here. I'm not sure if I just named that differently locally, so I'm going to run with this and I'll just update it afterwards if needed. So I executed this cell here. And what that did is it loaded the TMD data into TaxBrain and then did, I called it TB static again, because we're going to do a truly static run, no behavior applied here. We'll show that later. And then with that run, just as we did before, we produced those revenue estimates. So with this table, you can see the updated number here. Now we went from 2.1 to about 2.5 trillion. This number is actually much more in line with what CBO or the budget lab at Yale and so on are forecasting. And that's because that TMD file is more accurate and in particular does a better job matching some of the higher end of the income distribution than that CPS-based file. Okay. So if you're running this, again, just in that Colab link I shared, you won't have access to this file. So this block of code is commented out and the CPS file is just used again in this case. But here you can see how I'm using a custom data file. And so what I call TMD dictionary here, this is the flexible way with which to pass data to TaxBrain, where you can specify any data file. So just provide the path to the data file as long as it conforms to those standards I mentioned that tax calculator is expecting as far as the minimum number of variables and their naming conventions. Pass a start year for those data, a path or a data frame for growth factors, and then a path or a data frame representing the weights that correspond to your file. You could also have no weights and just look at what happens with your underlying data file. But those are some things that we can be very flexible with. Here I'm passing the TMD file, but this could be any custom data file you have based on administrative data or survey data you have access to. Again, just change to conform to the naming conventions expected by tax calculator. But this does give a very flexible way to pass the data you would like to use for your analysis to TaxBrain. Okay, so that's kind of enhancement number one with TaxBrain, this ability to use alternative data sources. And then it's also helpful that there are some existing data sources that are quite good, like the TMD project here. And there was a question from Mark in the chat, and he's asking, when we say combined here, yes, this is indeed the combined payroll and individual income tax liability. We can specify just the individual liability just as II tax, excuse me. II tax, I'm forgetting, yeah, so II tax, or we can have the payroll tax liability only. So we can specify that as we want. And we can also, kind of break out if we wanted to do analysis separately of the income versus payroll tax revenue changes. And I'm going to show you next how we can do line by line analysis of provisions in a broad proposal. So if we took, for instance, this proposal of extending those temporary provisions of the Tax Cuts and Jobs Act, if we want to break those out and look at what if we just change the rates, how much does that cost? What if we just extend the CTC provisions, what does that cost, and so on. To do that in TaxBrain, you need to just provide it with the proper input. And that is, it's going to expect, if you want these things done line by line, we're going to tell it to do a stacked revenue estimate. And when doing that, it's going to expect that our reform dictionary is going to follow a certain format where we're going to have essentially another level to that dictionary that is going to be kind of the grouping that we want to do those line by line estimates in. So what I've done in this next line is I've taken all of those provisions outlined in that extension of the TCJA file, and I put them in groups. So first group here we've assigned is lower taxes on ordinary income. And so we put all those rate changes right there in that grouping. Okay. So after that keyword, lower tax rates on ordinary income. And then expand the CTC, and we've got the related CTC provisions. Expand the AMT, and I've just pasted in those AMT provisions. All right. So I've just taken that original JSON file and kind of carved it up, putting each of the groups of provisions that are changing into associated values for different keywords in this dictionary, like expand the CTC, expand the AMT exemption, and so on. We got changes in standard deduction, limit itemized deductions, and so on. So we're breaking these provisions up into like 8 or 9 different groups. And we're going to produce a stacked revenue estimate that's going to provide the changes in revenue attributable to each of these categories. Okay. Now, as far as like stacking order, the stacking order of those changes, so like, if we're going to, what do we do first? Well, it's going to follow the order you put things in this dictionary. So here we're saying first thing we're going to do is lower rates. Then we're going to level on top of that this expansion of the CTC, then the AMT changes, then changes in the standard deduction, and so on. Obviously, you can change this order to suit your preferences. The numbers will change, like the order matters, right? So like, increasing the standard deduction, the cost of that is different depending upon what the individual rates are. So if you put this increase the standard deduction before the rate changes, you're going to get a different number. So be mindful of your stacking order, and it is important. But this will allow us to break out each of these provisions. All right. How do we then interact with TaxBrain to get this stacked revenue estimate? Well, we're going to instantiate a TaxBrain object just as we did before, start and end year, tell it what data you use. And we're going to utilize, in this case, though, this keyword argument called stacked. All right. And so we're going to set stacked. The default is false. As we saw above, we didn't change that. We didn't even touch that argument. And we just got a total cost of all of the provisions together. Here we're going to say stacked is true. And then the reform we're going to pass, we've got to pass, since we're saying stacked is true, we've got to pass this stacked reform dictionary we created. So now it's going to expect this dictionary with these provisions grouped together. So we're going to set up this, instantiate this TaxBrain object. We're calling it TB stacked. Then we're going to simulate TaxBrain with this stacked object. And then I'm going to print, just as we did before, this revenue estimate. But in this case, I'm not calling weighted total, but I'm calling this stacked table method. And then we're going to, again, put things in billions, but we're going to have this stacked revenue estimate table that's going to give us the cost of each of these different groups of provisions. Okay, so what is the cost of just changing the rates? What's the cost of just expanding the CTC, and so on? And again, we're doing this for each of the 10 years in the budget window. All right, so that took a little longer to run than before. And why is that? Well, that's because we're simulating this model many times. really once for each of those values in that stacked reform dictionary, because we're going to find all the cost of lowering the rates. Then we're going to layer on expanding the CTC, simulate the model again, and so on. All right, so it was a little longer to run this, but again, we're simulating this model over 10 years for what do we have? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 different times. So this is, again, hundreds of thousands of records being simulated, more than, 200 times essentially here. All right, and Mark is asking in the chat, just to confirm the combined individual payroll tax and I assume tax credit outlays. And yes, cost of credits are included here, and we can see that, for example, the CTC expansion and the extension of that. And so we can see line by line how much of each of these provisions are costing when we've got a total row at the bottom, right? So we can get a sense, some of these are, revenue losers extension, and then some of them are revenue gainers, like, limit itemized deductions and eliminate personal exemptions, right? Extending those things help raise revenue. All right, so we can get, again, we're still at our total cost of about 2.4 trillion here. And we've got it broken up by each of these provisions. Okay, so that was the kind of second nice thing about TaxBrain. First was custom data. Second is the ability to do these stacked reforms. Again, produce revenue estimates. Again, very similar to what the Joint Committee or others are doing. Third is we can add some behavior to this. So you'll notice, I called those static runs before because they were truly static runs. We had individuals earning the same income or claiming the same income under that reform of TCJA extension as they did under the baseline current law policy. Now we'll interact with TaxBrain by having it talk to another model. It's called the behavioral responses model. This is also a PSL catalog model, also something like TaxBrain that interacts with tax calculator. And this model is going to allow us to layer on, microeconomic behavioral responses to these micro simulations done by TaxBrain. All right. With TaxBrain, again, it's got this nice interface. It's going to wrap tax calculator and this behavioral responses package. And so we're going to do a dynamic score, or a score where we account for microeconomic responses to these changes in marginal tax rates. What we need to do, as far as with TaxBrain, is instantiate our object just passing one more argument. And that argument is the keyword argument behavior. It's expecting a dictionary that specifies the elasticities that this behavioral responses package linked to here is expecting. Those include substitution and income effects, and there are separate effects for responses to capital gains taxes. Right. So this, I guess, is going to answer Benjamin's question about are there any micro behavioral responses? And this is exactly how we're going to get these in the model, by providing a value to this behavior argument. The default is no value, so a truly static estimate, but we can layer on this behavior. Again, to the extent that it's allowed by the behavioral responses package, which has flexibility in terms of income and substitution elasticities on ordinary income, and then also a separate elasticity on capital gains income. There's great documentation in the behavioral responses repository. The source code is very readable. It's just a short number of lines of code to make that package. So it's very easy to see how to specify these values and how they relate to empirical estimates from the literature on the elasticity of taxable income. Here we'll provide kind of a standard value here for a substitution elasticity of 0.25 and provide that as an argument. And then we're just going to use the run method to simulate that model. Again, this is going to take longer than doing that static run, because what's going on behind the scenes is the model is being simulated for the baseline and then for the reform. Marginal tax rates are computed for the reform. We're seeing those change in marginal tax rates, and based on that, we're applying the elasticity to the changes in marginal tax rates. And so then we've got to update per the behavior of people's income and then simulate the model again. So for instance, with this behavioral response of 0.25, this means, so with permanence of TCJA, that's going to keep marginal tax rates lower. And so we're going to see lower marginal tax rates relative to current law. So the substitution effect is going to have a positive effect here. People are going to work more, report more income than they would if we didn't extend TCJA. And so people's, before tax wages, for instance, are going to go up. And now we've got to simulate the model again with those higher wages to compute their new tax liability. So the dynamic runs take a little bit longer because you essentially need one more run through of the model. All right, we can compute then what is liability. And so we went from something like 2.4 trillion to now just under 2 trillion in that revenue estimate. So we can see, what those dynamic responses yield. And it's about, it makes the extension look about 500 billion cheaper over that 10-year budget window than if we didn't account for those responses. Higher elasticities are going to have, a larger response, lower elasticities, a lower response. And so those are important things to report with your revenue estimate. They have, as you can see, significant consequences here because they're relatively large effects on marginal tax rates, especially for the high income earners of TCJA extension. All right, so we've got, examples using alternative data sources, examples stacking your revenue estimates here, examples doing scoring with those microeconomic responses. And you could, of course, layer these all together. We could have had stacked equals true and the behavioral responses and package that all together here if we wish. All right, and hopefully you're getting an example of or a sense of how to do that, right? We could have just add the stacked argument to this call to instantiate a TaxBrain object and passed the appropriate stacked reform dictionary and done both of those things together here. Yeah, so Rick's got a comment about, what do policymakers want to see? And the traditional revenue estimates produced by the Joint Committee are going to have these micro behavioral responses included with them. So I think the static run is useful just to get a sense of, okay, if I made no assumption about changes in behavior, what would this cost? But if we want to do something that's more realistic and also more similar to what we're seeing from scores from places like the Joint Committee on Taxation, we're going to want to apply these micro behavioral responses. All right. And then, finally, we can do some distributional analysis. We could, of course, dump all these data from TaxBrain, all of those individual records. You can use Excel, whatever you like, to visualize them. There are a few handy plots built into TaxBrain. Here's a distribution plot, so you can kind of look at winners and losers by income category. You can change the income category you want. This is the broadest measure of income called expanded income. And we can see kind of who are the winners and losers. And so we can see that this is changes in after-tax income. So we see like 1 million or more. Most people, the majority, are seeing a decrease in or an increase in after-tax income, but there are some in that high income group seeing a decrease, right? Because maybe they would have benefited more from the state and local deduction not being capped than from the reduction in rates. Another visualization back in 2017, the New York Times had a nice article about the implications of the Tax Cuts and Jobs Act, where they used Tax Calculator to simulate policy, and they produced this kind of neat dynamic visualization called a volcano plot. That's now an option in TaxBrain, so we can produce that volcano plot here to see, again, another view of what the distributional impacts of this permanence of TCJA would be. Here we've got kind of winners and losers in different colors. So this is change in tax liability. So the winners, so to speak, those who pay lower taxes are in this kind of teal color on the left side of zero. The losers, so to speak, those paying more tax liability after extension of TCJA are in the pink dots, each dot representing a filer in these, in this case, in the TMD data. And so you can see, the density to the left of the zero. So more people are winners than there are losers, but, not everybody's a winner from extension. And if we look at kind of this fanning out of this volcano as it, explodes, higher income folks are definitely going to have much larger changes in tax liability, particularly much larger tax savings on average. Okay, so we've now looked at revenue estimates and distributional analysis. The final thing I want to share here is on the corporate income tax. So everything we've done so far is looking at the individual income or payroll taxes. So looking at revenue estimates and distributional analysis of those. There is the ability in TaxBrain to also distribute the corporate income tax. And so let me provide here an example of how that's done. There's kind of two steps to it. The first is to kind of set up what your assumptions are about the incidence of the corporate income tax. And then you're basically just going to pass those assumptions to TaxBrain and it'll handle the rest. Okay, so what is it expecting in terms of the assumptions about the corporate income tax? Well, first off, not an assumption, you would need to provide some measure of the corporate income tax revenue that's associated with this policy change. So here I've got corporate revenue change of 10 billion per year for each year from our start year to our end year. So I'm going to have corporate revenue, corporate income tax revenue of 10 billion applied each year from 2025 to 2034. And then we're going to look at the incidence of that corporate income tax. So this is going to be, so our revenue estimate here would be, this would be like we cut the corporate income tax and that's costing 10 billion per year. We want to, see the incidence of that across individuals. So for that incidence, we're going to need to provide some assumptions about how that falls. So there's a long literature in economics about the incidence of the corporate income tax. There are many different estimates, but we'll take a score or kind of the middle ground here, which is that labor is bearing about 50% of the incidence, and shareholders are bearing about 40%, and then other capital holders through equilibrium changes in returns to capital are bearing about 10%. So this incidence assumptions that are provided, TaxBrain is expecting a dictionary that looks like this, where there's a keyword incidence, and then there's values for each labor shareholder and all capital shares. And then there's one other argument that's needed in these incidence assumptions, and that is the number of years until you reach kind of the long run or until this incidence is fully phased in, because the assumption is that upon impact, there's not the ability to shift the burden from capital to labor, say. So capital is going to bear all the burden in the initial year. And then until this long run years is hit, we're moving towards that long run number, like in a linear fashion. So if it's 50% on labor after 10 years, we're having 5%, 10%, so on up to 50% after those 10 years. So you can change those long run years to have this phase in more quickly or more slowly. And so you could have it phase in immediately if you wished, but we'll say 10 years here. All right, and once we've specified that in the proper format, again, given the revenue changes and then the incidence assumptions, we're going to then instantiate our TaxBrain object. Here we're going to use the TMD data. We're not going to do a stacked estimate, just our overall estimate. We're going to apply behavior, and then we're going to provide the corporate revenue change and the corporate incidence assumptions to that TaxBrain object. We'll call it TaxBrain with corp will be the name of this object. And then we'll use the run method to just make the simulation go. All right, so it's going to run that model, and it's going to then attribute those corporate changes, right? So if we have corporations are paying less tax, that means they're going to pay more wages and they're going to pay more dividends or capital gains. And so that's going to flow through to the individual records here based on, again, these incidence assumptions above. Okay, so then we're going to have changes in wages, and we want to compute how those changes in wages or changes in capital gains are then taxed under the reform policy here. Again, we're doing these hundreds of thousands of records over 10 years, multiple times here to get the liabilities under both the current law and then under that reform policy. All right, and then after running that, I just executed this distributional plot, which we could see is different than before. So there's going to be some more winners in the high income group where there's more capital income in particular. And then lastly, I'll just show how this affects revenue, right? Because there's this offset. When we have this cut to the corporate income tax, that's going to raise, as I said, wages or capital gains or both. And that's going to mean more income that's taxed at those individual rates. So there's some offset here, and that's what's represented in the differences that are shown in this table. So basically, like the corporate rate cut of $10 billion per year there'd be some offsetting effect on individual income taxes, about 26 billion over those 10 years. Okay. given these incidence assumptions here. So again, TaxBrain useful for flexibility with your data, ability to do stacked reforms, ability to do microeconomic responses, those behavioral responses to changes in marginal tax rates, and then also to analyze the incidence of the corporate income tax. All right, so let me check the chat here. I think I saw a couple questions that I did. Okay, so I think the question, two of them here. I see one from Benjamin who's asking about apply different elasticities to the different tax brackets. That is, I don't believe currently flexible in the behavioral responses package. I think in principle, it's not too difficult to add. I'm not a maintainer or developer of that package, but
Jason, I think there is
that should be something that one could do. Matt,
I think there is a capability to do that in behavioral responses that Mard and Holmer added a few years ago.
Okay.
Benjamin, if you shoot me an email, I can try to dig it up and send it to you later.
And that would be done, and then that would be done through that dictionary, I presume, where you would have different elasticities where we specified the substitution. Okay. Okay, and Max Guinness is confirming he's done that. I have not done that, but that is an option there. And Will McBride is asking about JCT estimates being larger than what I showed here. What explains the differences? And again, there are some differences in terms. So if you look through the line by line, I think you'll find they're pretty close. But for instance, we're not doing the estate tax, which they do. There are some other off-model provisions off this, individual income tax microsimulation model that JCT is doing. But I think if you look line by line, these should line up reasonably well. I did provide a link to the Budget Lab at Yale's estimates on a line by line sense, and again, within a few billion on each of those line items there. But yeah, so yeah, that TMD file should be fairly accurate. I think quite accurate in my inspection. But I would just, for that large of a difference here, about $1 trillion, I think you want to look towards some of those provisions, like, again, the estate tax is over 100 billion in revenue over those 10 years.
So that doesn't include the estate tax. That's just the individual provisions, not estate tax. So are you doing the pass-through deduction?
Should be in there. I got to look back at that JSON file, but that should be in there. Yeah, that is there. Yes.
Isn't the main difference that you don't have the business tax revenue, but it's just the individual?
Yeah, this excludes that as well. This is the JCT's number is just individual, doesn't include bonus, depreciation, all that. Yeah, we're able to match it at Tax Foundation. I mean, it's not an accident that we're matching JCT. We're targeting JCT over over the years when we see they publish something. But in a lot of cases, we're targeting underlying components and stuff. But looking at the underlying components like the rates and brackets alone, we differ from JCT. By 10 to 15%. It's just they're offsetting errors. But just curious, what if you've looked into it at all, and what your guess is?
Yeah, it's been a few months since I did it in detail, but I kind of, my sense was kind of going through line by line that things were looking pretty good, and that was mainly due to some missing provisions, but again, it's been a few months, so I would need to go back to be sure about that. Yeah.
Got it.
Awesome. All right. Well, I appreciate you guys' attention and those questions about that chat. So we're going to take another 15-minute break. We'll resume here at 11:15, or I guess 10-minute break now. So we'll come back at 11:15 and we'll look at business taxes and incentives on investment. All right. Great. I'll see you all then.